Welcome to the At the Coalface podcast with your host, Jason Greenwood. This podcast is all about what it's really like in the trenches of digital and e-commerce. Jason, Andrew, it's awesome to have you on the pod, mate.
Likewise, Jace. It's a pleasure to be here.
Cheers, man. Cheers, man. I know that obviously you've been super busy lately. I see, you're very active on LinkedIn. So I feel somewhat privileged, to be honest with you, that I could carve out a little bit of time with you today, given all the things going on in your world at the moment.
It's my pleasure. It's the facade of social media. It makes people look bigger and bolder than they actually are. So some of it's facade, most of it's facade, but some of it's real.
Awesome. Yeah, no, I guess we all have to do what we have to do to sort of keep our name in lights. If we have to be our own best advocate on social media, that's for sure.
For sure.
Well, look, it is awesome to have you here, and just for anybody that doesn't know you, I think it's you're pretty well known, especially in ANZ. So I'm sure most of the audience will know who you are, but particularly for the audience in North America, which is a rapidly growing audience. You've written the book Start Naked Numbers, which really helps merchants understand the underlying key numbers and key metrics that are driving their business and their profitability or lack thereof. Which is awesome. I think it's an important piece of material to get out to the market. Obviously, you're co-founder and director of SBO, which is a financial accounting sort of primarily. You've gone to great pains to say that historically SBO were financial accountants versus tax accountants, although I understand you've recently started to get into more the tax accounting side of things and taking on resources in that area as well. So I'll get you to sort of speak to maybe the difference between those two and how you decided to specialize and really drill down into financial accounting for merchants in the first instance. You're also the co-founder and director of Arbor Group, which is a broader financial services group and produces content, and I'm pretty sure newsletters as well, and then obviously educational content, as well as learning programs. And I see recently that you've also joined in with Shopify, and you've produced, I guess, a video learning series as part of the Shopify education blog and all the rest of their content work that they're doing. So, mate, you seem super busy, and it is exciting to have somebody like you with your financial acumen in the market, being active, putting out a lot of content. I follow you really closely on LinkedIn, and your posts are so enlightening. They're really timely. They are really applicable for merchants in their businesses because, oftentimes merchants get, particularly e-commerce merchants, they get wrapped up in trying to do the operational work in their business. They get wrapped up in running campaigns. They get wrapped up in running promotions and just keeping the wheels on. And so oftentimes maybe they don't have as much of a grasp of their financials as they possibly could or should. And that's where you come in. So maybe you can just, share a little bit more about how you got into what you do, a little bit about your elevator pitch, and how you really started to focus primarily on e-commerce merchants and omni-channel merchants as part of what you guys do.
For sure. Thanks, Jace. Very well researched. Well done. So I guess when people think about accountants and what accountants do, it's most people think about tax returns. So, you mentioned, hey, I'm always in Uber drivers. When I take Ubers, the Uber driver is always asking, hey, so what's your day job? What do you do? And I usually say, oh, I'm an accountant. And they just there's two options. They just go quiet because it's like, this guy's so boring. I don't want to engage in a conversation with him. Or they default to, oh man, I haven't done my tax return this year. And they start asking questions about tax deductions. And I'm pretty quick nowadays to tell them, well, actually, I don't know anything about tax. Well, I do. I used to work in tax, but it's been about 8 years since I've lodged a tax return for anyone, including myself. So I think there's a big misconception in the market, particularly around small business and small business owners and founders about what accountants do. And I think most people associate, again, accountants doing tax returns, and we don't do any tax returns. If you look at large companies and corporates, they've got CFOs, they've got management accountants, they've got financial accountants, they've got a team of suites of different accountants. And the taxes is only one sliver, one kind of small role of what accountants actually do. A lot of it is about financial control, understanding margins, unit economics, cash flow. And so that's kind of really the function that we bring to the small business market. It's quite rare to see accounting firms or accounting agencies like us in the space, because again, most small business accountants are solely tax return focused. Our direct focus is what we call operational finance, and that basically is everything from getting your books in order to running your payroll, but then also strategic financial management. How do I, with the money I've got, how do I control my expenses? How do I turn that cash into more cash? Capital allocation, all the stuff that you expect from a CFO in a big business, we bring that to small businesses. And so why we started this company was, my background was originally in small business taxes. So I used to work in a global accounting firm doing kind of tax returns and compliance for small businesses. And then I got exposure into corporate finance, and that world involved mergers and acquisitions, valuations, and it really gave me an idea of, oh wow, this is what accountants should be doing, which is helping clients understand their margins, get them liquidity. And so what we tried to figure out was, why wasn't there a company that specialized just in this type of work? And we noticed a big gap in the market. So that's our company, SBO Financial. So that's what we are today. SBO is one subsidiary of a few different companies that we have. As you mentioned, we have Stark Naked Numbers, which is a book I self-published 2 years ago, which is really pitched as trying to improve it was written to improve the financial literacy of entrepreneurs. So we work with a lot of founders, and if you think about the education system in any school, you go to school, you don't learn anything about credit cards or interest rates or compound interest. Then you get a mortgage, you get a car. That's the world of personal finance. And so no, you're not really equipped with these financial skills in the world. But then you start a business, right? And so you have e-commerce founders, particularly starting businesses on Shopify, and they grow quite quickly. You can get to 0 to $1 million of revenue pretty quickly, but then everyone's just focusing on top line metrics like revenue and ROAS, but no one's talking about margins or cash flow. And with these type of businesses, you can get to 0 to 1 really quickly, but you can also go to 1 mil to bankrupt pretty quickly as well, right? If you don't pay attention to some of the key fundamentals. And so we see our role as not in addition to being able to service our clients well, but also educate the market about knowing their numbers and improving their financial literacy to hopefully run a better business, improve their cash flow, and run a better lifestyle business, to be honest.
That's brilliant, mate. I think you're filling a really important gap in the market with what you do. And, you're probably one of the most visible players in your space. I can't actually think of anyone else, at least in the ANZ region anyway, that's more visible across social, particularly LinkedIn, than you are. And obviously you've done some collabs, as I said, with Shopify. You've done some collabs with some other players. You really are a content gun. I don't know whether you produce your own videos, because if you do, they're always really well done. You're really well spoken. You're a good presenter. You break down really complex concepts into simpler, bite-sized pieces that I think are digestible for small and medium-sized business owners. But I think, as far as I'm aware, and you can correct me if I'm wrong, you also work with agency founders and owners as well. So it's not just working with the merchants themselves and working with small and medium-sized businesses, but you also work with agencies that have to work with these businesses to help the agencies understand their own numbers, ensure that they're sustainable, ensure that they have the capital to grow, ensure that they have the operational structures in place from a finance perspective that will allow them to have financial rigor around their pricing model, their productization, if that's the direction that they choose to go, of their services, understanding market intelligence. And you really do offer, I guess, the gamut of services for the merchant space and those that serve them. So maybe you can speak to that a little bit, and how you work with agencies to help improve their financial literacy, and then obviously the trickle-down effects of that and how they engage with their merchants, and try to see things through a really data-informed and financially sound lens.
Yeah, for sure. So I guess the mantra of SBO is that our tagline is like the home of high growth businesses. And so we service, in addition to e-commerce, we service agencies, as you alluded to. We also service a lot of SaaS companies, like funded tech startups. Even just, we've got a few more traditional businesses that aren't solely digital. Like we've got some so we've got some telehealth businesses now on our accounts as well. So I guess our lens is to high growth businesses. So we're not really for the mum and dad fish and chip shop or the corner store cafe who are, limited by, the local postcode. I guess it's all of our clients think globally, they think big, and I guess naturally where the emerging economy is in digital, as you mentioned. So that typically lends itself towards agencies, e-commerce or software. So from an agency lens, I think that my business, SBO, and other businesses, that it is a service-based business. So we are leveraging people to produce a service, and that's how we generate margin. And I guess through the learnings of our own, how we run our own business, we can apply that skill set or that framework to other service-based businesses, whether they be a creative agency or a Shopify dev shop or a just a more PPC or a paid acquisition agency. Like the economics are actually all very, very similar, or how you think about the economics or how the business should be run. And so, through our own experience of building a, fairly well, I think operationally from a financial perspective, I think quite well managed business from SBO's perspective, but also be able to learn and build out a playbook for other agencies to improve their economics. And help them run better business, and then also allow them to service their end clients better. I think it's a win-win.
So really using yourself as the guinea pig, sort of eating your own dog food, to use the phrase, so that you use your own business as almost a test bed for your sort of theories and some of the things that you know to be true, but by putting them into action, you can tweak them and you can refine them, and then you can take that back out to the market and say, well, here, client service-based businesses, they really are selling time for money. It can be packaged 1,000 different ways, but ultimately you're selling time for money, and that could be, as you say, that could be an agency, that could be a consultancy, a one man woman band type of consultancy. It could be basically any business that is ultimately selling time for money in one way, shape, or form. I guess those learnings that you carry through your business and those tests that you run in your own business, those are, as you say, almost directly applicable to any service-based business that is not just, say, either manufacturing or importing a product and whacking on a margin and reselling it.
Yeah, it's exactly right, and I think it's a really good point that you've raised. Like everything, all the advice and all the frameworks and the tactics that we roll out for all of our clients, they're all tested. Like they're not just kind of stuff you've read on the internet and like, they're quite vague. It's like, how do I improve the profit of my business? It's like, we'll just raise your prices. That's the default response by most accountants. Or it's like, hey, you just reduce your costs and you will make more money. It's not as simple as that, as everyone knows as business owners. And so we get into the weeds, and I guess all the things that all the frameworks that we roll out is tried and tested. We are the guinea pigs, and I'll be frank, a lot of our clients are guinea pigs as well. We've got tactics that we, particularly for e-commerce, that we like to roll out from a financial economics perspective, and some put their hand up to say, let's give it a go, and have actually seen some pretty good results out of them. So again, I guess through the nature of being able to specialize in certain business models and industries, we can get very deep into playbooks and start to write our own kind of IP, which can be rolled out for future clients, and hopefully get consistent results.
For sure. Yeah, look, I guess that's, again, eating your own dog food is really critical. And I think, that maps really nicely to kind of some of the things I do as a consultant, in the sense that, I've been there and done that, not only from the merchant side, but also agency side, working with many businesses. And you do develop, they're almost like design patterns, right? They're, you call them maybe a playbook. In my industry, we maybe call it maybe a little bit more like a design pattern or an architecture pattern. And so you kind of, when you go into a business, you oftentimes see the same mistakes or the same pitfalls or the same opportunities recurring over and over and over again. And you kind of go, okay, well, I've done this with these other three businesses, which are very similar. And I know this is either a tech stack or an operational structure or a people structure that really works well. And you can pretty rapidly turn it into a profitable, well-oiled machine. And so you can help businesses understand what that framework is, the value that it brings to their business, and then help them roll it out. So one of the things that I absolutely love about your content is that you rail pretty mercilessly on the discount mentality of a lot of merchants. And when I refer to that, it's almost like the Briscoe's mentality, or it's almost like there's a lot of chain businesses that unfortunately have trained their customers to expect discounts, and therefore effectively, wow, I don't know if you can hear that rain in the background. Hopefully it's not too loud, but man, it is absolutely hosing down here. I actually think I see some hail as well, which is pretty crazy. But anyways, yeah, look, you've railed pretty mercilessly against those habitual offenders when it comes to perpetual discounting and the absolute underlying damage that does to both profitability, but also the psychology of the consumer itself, and creating an environment whereby you have to continue discounting. It's almost like a drug, right? It becomes a revenue driving drug for businesses, and they become addicted to it, and it becomes really hard to break that pattern, both for them internally, but also for their customer and buying psychology. And it's really an insidious part of the e-commerce industry that I've seen over the years. Brands don't value their brand highly enough. They don't respect themselves highly enough. They don't respect the products they sell highly enough. And this is particularly endemic across merchants that are Me Too retailers. So they're not a manufacturer, they're not a wholesaler, they're not a distributor. They basically buy somebody else's stuff with somebody else's brands. In many cases, they might not even have exclusivity on those products. And then they just try to be the cheapest or one of the cheapest without a tangible value add. And in that environment, I think they're going to find themselves with their pants down and very vulnerable moving forward as globalization continues to bite and the adoption of e-commerce continues to accelerate. Maybe you can speak to, your focus really on margins and profitability for businesses as being the underlying growth drivers for sustainability and survivability for pretty much any business that operates in the retail world.
Yeah, it's a really great points you touched on there, Jay. So, if you look into the media, if you look at the Forbes, 30 under 30 list, or the AFR 100 rich list, or any list, right, promoted by TechCrunch or any large publication, you look at they basically like to rank companies, right? And you look at these companies, and it's all from the lens of high growth. Typically, it's like, hey, look at our team size, look at our headcount growth, look at our revenue growth. And from my view, that's all vanity, like complete capital raise, like how much capital we've raised. That's complete vanity metrics. Like, just because you've raised a bucket load of money, just because you've grown your revenue from 1,000% year on year, just because you've hired like a bucket load of people, doesn't actually mean anything. It just means that you're like, yeah, cool, you've got a lot of traction from the outside. You're on a list, good on you. But like, doesn't actually tell you anything of the unit economics or the feasibility of that business over the long term. And so I think straight off the bat, there's this big focus on vanity metrics, and it's easy for entrepreneurs to get caught up into that wave where it's all about raising money and focusing on top line revenue. But I guess it's surprising where we have the pleasure of seeing under the hoods of great well-known brands, and even we like to do these in our financial teardowns, where we look to strip back kind of large companies who share their financial information and actually assess what lies under the hood. And a lot of them are disasters. A lot of them have really poor unit economics or fundamentals that we see in the short term anyway, right, from a financial lens. And you start to question, like, is this actually sustainable? Like, what is the value proposition really here, and how is this going to be a business in 10 or 15 years? And there's a lot of question marks around that. So I think straight off the bat, there's a lot of focus on emphasis on top line metrics, where our lens is like, well, let's have a look under the hood and actually understand what are the economics of this business. And yeah, it might be burning money now or losing money now, but how can we, is it sustainable over the long term? So I guess take that lens from discounting. I think if you look at, when people talk about growth, they talk about top line growth. And thing about top line growth is that, if you have a product which is worth $100, or you sell it for $100 but costs you $120 to make, well, of course you can sell a lot of them, but you're just gonna be selling yourself into bankruptcy because you'll be losing money on every single sale. So I think there's a big trend of people looking at the wrong metrics, number one, or they just obsess around trying to compare themselves against other people or other brands, and fall into that trap, because the most effective lever to grow top line is discounting. Let's put it that way. And if you say that you're going to put a 50% store wide sale, like, yes, you will have a higher conversion rate. Yes, you will probably sell more orders, but will you actually make more money? Pretty unlikely. Most brands, probably barely scrape 50% gross margins after fulfillment and merchant fees. And so, I think there's this big obsession sometimes with just discounting to fill orders. And yeah, it's not often the best strategy. I've rarely seen it as the best strategy unless it's intentional. So, there are big box retailers like Costco, for example, who, they've already positioned themselves as the market as the lowest price, and and they don't need to discount because they're already the cheapest. But the thing about Costco is they don't make their money from selling the products; they actually make it from membership fees, right? So, if you want to be kind of a discount retailer, you got to think about how you earn your margin rather than making it from products itself. Because as you said, it is a slippery slope. It's easy to get caught up into that discounting cycle where you're just running sales at like Black Friday, Boxing Day, or Christmas, and then Easter and in the financial year. The trap is that you just become a very seasonal business where you're selling make all your sales on those 4 peak periods and losing money at the same time, and it's just not a great way to build a business.
Well, you raise a very good point, and I think this mentality, unfortunately, has broader downstream impacts in these businesses that creates behavior that actually reinforces bad behavior by their clients. It reinforces bad behavior by their business, and ultimately that's borne out by a long-term decline in net margin and retained margin for businesses. And we're seeing that play out, and I just want to get your take on this. What I'm seeing as a consultant in the marketplace is that the impending death of third-party cookies and the privacy changes are actually forcing merchants in many respects to reform their behavior and their approach to acquisition, because acquisition costs are going through the roof. So when we look at, Google ads and Facebook ads and a lot of the other digital marketing and acquisition channels, their annual inflation rate is going through the roof. So Facebook says that over the last 12 months, for example, that the number of ads have increased about 50%, or the demand for ads has increased by about 50%, and average ad spend has increased by about 30%. So if we look at, the broader market inflation rate of costs, between Australia and New Zealand, it can range anywhere from sort of, depending on what metric you're looking at, 2 to maybe 4, maybe 5% a year inflation. And then we look at ad inflation, and it can range, depending on the vertical and the space that you're playing in, anywhere from 10 to 50% annual ad cost inflation or cost of acquisition. Let's just put it into the bucket of acquisition costs. If your cost of acquisition is compounding at 10 to 50% per year, that automatically becomes unsustainable for a business that is a marginal business to begin with and is a perpetual discounter. So we see this bad behavior play out across many other functions of the business, not just in the promotional elements of the business, but we see that quest for growth at all costs play out in the type of customers that businesses are acquiring, how they're acquiring them, and then that also pollutes their customer data to the point where now we're acquiring really cost-sensitive and price-sensitive customers because of the way that we're targeting. Our entire growth is predicated on the concept of acquisition. We don't have a focus on retention-based marketing. We don't have a focus on customer lifetime value. We don't have a focus on RFM metrics, and we don't have systems or processes in place to leverage zero and first party data to build a real relationship with our customers that has a long-term value to our business, nor are we able to segment down into cohorts that are really valuable to our business and then use those cohorts to go out and target similar consumers in the marketplace when we do acquisition. So we're doing ourselves a disservice in every respect across our business when we become a discount and growth focused business. At all costs, we're just destroying every single fundamental foundational pillar of our business. And so I actually see these changes in the marketplace, whilst painful in the short term, it's actually forcing businesses for a change to think sustainability long-term around how are we going to grow our business without the benefit of the historically cheap acquisition we've always had access to.
It's so true, and I think just going back to the CAC or the lower returns on paid acquisition. I mean, that's being massively fueled by the macro environment that we've got at the moment, which is quantitative easing, low interest rates. There's a bucket load of capital being injected into the economy, and investors are looking for yield. I can't get by. I can't keep it in the bank, so I need to invest. And in these. Just because there's a lot of sexy D2C startups that are raising buckloads of capital at crazy like SaaS valuations, which completely different economics. Indeed, an e-commerce business has very different economics to a SaaS business, like completely different. But but they're being valued at SaaS valuations for some reason. But so you've got this money going into these brands, and they're just pumping most of their dollars into acquisition, right, into Facebook, to Google, and so naturally the price of those channels like skyrocket, and will continue to do so much as there is more capital being pumped into the economy. So I don't think this is a short-term issue. Like, this is forever going to be more expensive until there's a big, until a bubble bursts or something fundamentally shifts in the macro economy. We're just going to continue to see this happening.
And do you help as part of, I guess, your services and helping to reshape the thinking and the mentality and the approach of these businesses? And I guess, as part of the work that you do with these businesses, do you also help them start to understand the consequences outside the immediate economic impact of their, I guess, chase for growth at all costs? Is that a discussion that you have with them to help them understand, look, if you acquire these cheap customers, then they're going to forever be cheap customers. You're polluting your data streams, you're polluting your segmentation, you're polluting your cohorts, you're polluting your opportunity to remarket to good quality customers that you actually want to acquire. If you're going to go out and spend all this money for acquisition, you might as well at least be acquiring customers that are closer to your ICP than just, for lack of a better term, the Walmart type shopper, which is, if we're going to forever be chasing the cheapest price on the internet, and they're not going to be brand aligned, they're not going to be brand loyal, and ultimately you're going to have to reacquire them every single time you sell to them because they're always going to go back to the internet to try to find the cheapest price. So I think there's some really insidious outcomes that come as a result of this growth at all costs mentality. And it's not just higher acquisition costs. There's much broader impacts around business sustainability. And are those the kind of discussions that you're having? And are you, I realize obviously you're not an e-commerce consultant, you are a financial consultant in terms of being able to help businesses understand their key growth drivers, their key profitability metrics, the key levers that they can pull in their business to ensure their sustainability over the long term from a financial perspective. But are you also starting to almost dip your toes in the water of what we would consider traditional e-commerce consultancy in terms of helping businesses to understand those broader impacts of these really short-term decisions based on short-term thinking?
Yeah, it's a really good question. So we're quite we always dance this kind of fine line as to what our role is within the business, and it is first and foremost the financial people, like we're the numbers people from a financial perspective in the business to our clients. And so, but when we're talking out of the more qualitative downside, where we usually typically work with partners, just people like yourself to educate the client, to just make them aware of any downstream impacts of their growth at all cost strategy. But what I would say is, we like to work within constraints, right? So, a big part of our process is developing financial models and developing financial budgets for our clients who, as scary as it sounds, a lot of these high growth businesses don't have a budget. We're working with brands who are, 200% year-on-year growth top line, but they've got no idea of how they should be investing that capital that how they should redeploy the capital that they're generating through a cash flow or from their customers. And so it's quite interesting. It's quite satisfying, actually, when you build a financial model or build a financial budget for clients and you actually help them set CAC budgets, right? So we think as CAC as a bucket, whether that's paid acquisition, retention, PR, brand, whatever those activities are, we think of that as a function of the business. Because yes, we can choose to spend all of our marketing budget on paid acquisition, but as you know, that's just one small slither of the entire acquisition journey of a customer, right? There's email and brand and influencers and all that sort of stuff. So what we say is, like, let's, rather than think about allocating budgets per type of marketing you do, let's just allocate what is the budget for CAC as a group, as a macro kind of function within the business. And what we recommend is, if you're looking for profitable, sustainable growth, we typically say 10 to 15% is a really good start. Obviously, it will depend on what your gross profit margins are. Higher the gross profit margins, the more margin you have left to redeploy into CAC. But for most e-com retailers who are doing kind of 50% gross margins after fulfillment of merchant fees, 10 to 15% is a good start, and that's kind of the ballpark. And so when you say that, okay, rather than thinking about my ROAS, or rather than thinking about, which is actually most people think in ROAS. So let's just forget about that. What we say is, well, think about maybe you've got 15% of your revenue to invest into marketing as a bucket, right? And now get creative with that. So it's as soon as you give people fixed targets of dollars, how much you could spend each month, they get quite, some people at the beginning because they're like, oh, I can't get the returns I need out of these dollars. And we say, well, that's fine, but what happens if we increase that marketing budget? If you're not getting a sufficient return from it in the short term, well, you're losing every dollar and you're losing money on every sale through negative contribution margin. So if you give them a fixed dollar, they start to think, oh, well, how can we be more creative with that money? Rather than thinking about advertising as a pure channel, how can we think about maybe we should do more email marketing, or maybe we should actually just do some old school trade shows or something like that, which are surprisingly effective if you're particularly for wholesale. So it encourages founders, like giving people constraints forces creativity, right? And if you start to work within constraints of the business, rather than thinking about returns all the time, but thinking about, here's this pot of money I need to get the best yield out of, it can actually drive different behaviors from people. And I think what you'll find is people start to default to the more organic channels that you're talking about, the more driving lifetime value, and the things that will actually build brand endurance rather than just chasing short-term customers.
Wow. Yeah, definitely. I can see how you would come in and really shake up a merchant's world and really cause them to sort of question everything they thought they knew about their business. One of the things that I see pretty routinely when I go into a business is, particularly when we start asking them questions like, what's your CLV? What's your AOV? Sometimes they'll know that. They oftentimes won't know what their CLV is. They won't know what their churn rates are. They won't know how to calculate it. They won't have systems or technology in place to help them calculate it on the fly on a rolling basis. And so they're really flying blind from a technical perspective because, these businesses are generating data at scale, and it's just well beyond the ability for these businesses, particularly if they're sort of running on a bit of a shoestring budget and they just don't have the people power inside to do the number crunching and the BI. They just don't have the ability to do a lot of number crunching internally to their business. And one of the things I often find is that not only do they oftentimes not know what their RFM model is, they don't know what their retention model should look like, they don't know what their CLV should look like, they don't know, what their CAC should look like, they just don't know any of those numbers, and even what the target should be for those numbers in the first place, based on the vertical that they play in, based on the buying life cycle, based on whether it's a consumable or not, based on a whole lot of other factors. This can affect and tweak the playbook or the model, as you call it. But the final thing that I see businesses really missing out on in terms of understanding their customer and understanding their underlying cost base is cost to serve or cost to service. And so all other things being equal, if you've got two customers that you think, hey, they've got the average, they've got the same AOV, say, for example, and this never happens, but let's just say all other things being equal, they've got the same CLV, they've got the same CAC because you acquired them through the same channel, and therefore your average cost to acquire them was about the same, and their revenue value to you, and maybe even their margin value to you, is roughly the same. If those two customers, if on average one customer makes 0.5 contacts to your customer service team per order with you, and the other customer makes 3 contacts to customer service, maybe 1 phone call, 1 email, and 1 live chat on average per purchase, obviously there's a cost associated with serving each of those customers, and those costs are very different. And businesses oftentimes, they don't assign a cost to each of their service channels for each the cost for each average contact per channel. And so therefore, and they don't have the operational systems to even pull that data out and then inject it as a component of customer data for segmentation. They don't have the ability to look through the lens of, okay, CLV is dramatically impacted. And if you're not looking at both CAC and cost to serve as part of your CLV calculations, your CLV is going to be completely up the wall. It's going to be worse than useless because it's going to be telling you the wrong things about your customers, and therefore you're going to be targeting the wrong customers that ultimately have a much lower margin, net margin to you as a business. So are these the types of things that you help businesses understand when you first go in and you say, look, all other things being equal, these are the kinds of things you need to understand about your customers to be able to segment better, target better, and ultimately be a more profitable business?
Yeah, I think you've really nailed it with the cost to serve elements. I mean, the biggest thing that we see is so we have a lot of omni-channel retailers, and so it's quite common for brands to have a wholesale and a D2C channel. And I think that you talk to these brands about what's your growth strategy, and through our budgeting workshop, and a lot of them say like, oh, well, obviously direct to consumer is better, right? It's like we can own the customer. We'll have better margins because we skipped the middleman per se, and we've got the email, all this sort of stuff. And when we actually crunch the numbers, it's actually, if you consider the cost to serve, the customer support team, the rising CAC, and and dealing with the Karens who are on the retail customers basically of the world, and then compare that to wholesale channels who are other business owners. Quite simple, they just have larger order volumes, lower margin, but there's very little other cost to serve those customers. It's actually quite interesting. The margins are actually sometimes exactly the same, or even sometimes better through a wholesale channel rather than in retail, because of all those costs. The cost to serve the retail, the crowd basically, right? And it's quite a fascinating observation for a lot of brands, because they obsess with we have to go direct consumer, or this is our growth strategy. This is what's on, which is what's hot. But I'm a big fan of wholesale. Like we were talking about B2B earlier. Like I'm a B2B business. I love B2B businesses because it's somewhat more predictable. You build enduring relationships with your customers and your suppliers, and it's just less stress. Honestly, like you're not dealing with 1,000 people. You're dealing with one person and their ordering team, and it's just a much better scenario. So I think that. We don't get to the granular level of per customer, but we'll rather think about per channel, because I think that's more easily grasped by a lot of folks. And as you said, sometimes getting data per customer is sometimes difficult to it's difficult to track and attribute in a way that is meaningful to the outcomes. Where we usually start with more a macro approach of the selling per channel, where that's through third-party agency, through a wholesaler, through a platform, and truly understanding the cost to serve on each of those channels.
That's beautiful. That makes total sense, and I think you're right. I think a business, if at first it can at least look at at CAC and cost to serve by channel, and not only by the channel that you're acquiring the customer through, but also through the channel that you're continuing to service the customer through, plus the actual customer service channels themselves, the cost to run those channels, the cost to deliver those channels to the customer, and provide that level of service that's required. And you make a very, very good point, which is one of the reasons why I've sort of consciously pivoted more into the B2B and D2C space, is because, the B2B businesses, they're used to selling, cartons and pallets and containers, as opposed to a courier satchel for every single parcel that goes out. And so you're right. When I go into consult, and the reason why, and a lot of businesses will say, well, how can you consult on B2B and D2C? They're completely different beasts, because D2C is more aligned with B2C. And it's like, well, no, actually they're kissing cousins, because as you rightly say, a lot of B2B businesses are either looking very seriously at a D2C channel as an improved margin opportunity for their business, or they already have a D2C channel and they're looking at trying to pivot more and more of their revenue split towards the D2C channel, because they think that it's automatically going to improve their margins. And as you rightly point out, that isn't always the case. It can be, it absolutely can be, but there has to be a massive mind and operational shift inside the business to allow that to happen, because where you might have had, say 2 or 3 account managers running across all of your B2B accounts. Let's say you've got, 50 B2B accounts, and you've got maybe 1 or 2 account managers that manage all of them. When you move into that D2C model, you now have to have usually a customer service team, right? And you now have the opportunity to potentially have to service a customer with every single order that they place. Whereas on a pallet, there might be, 500 items on that pallet. Well, and that's going to 1 B2B customer, whereas those 500 items might be going to 500 D2C customers, and therefore the exponential growth in service capability has to be taken into account. And not only that, but the psychological expectations of B2C customers are completely different as well. So they expect to be able to get a hold of you through live chat, email, phone, carrier pigeon, pretty much everything else. Email, basically, social media, Facebook Messenger, Instagram DM, Twitter. They expect to be able to get a hold of you basically at any channel that's convenient to them, and that exponentially grows the channels that you have to support.
Exactly right. Yeah, it's like quantity versus quality, right? It's like how many, yeah, and that's again, I don't think I could ever operate a D2C business, or even a B2C business generally. Like, I'm always being B2B. I'm an accountant. I prefer to go deep in my relationships and have less relationships the better. And that's just me as a person. But I just couldn't fathom the idea of, being contacted by the Karens, of the world, through all the channels that you described. And then by the end, you try your best and they ask for a refund anyway. And you get nothing you lose. It's just complete sunk cost. And it's like, oh God, why?
Yeah, why am I even doing this? It does make you question it some days, but you hope to offset it with volume, right? Even though it's, but to your point, I think a lot of businesses, they need that wise counsel from people that have been there and done that, or at least help businesses, go there and do that, and can at least give them some heads up in terms of trying to minimize the surprises that they're likely to encounter. And you can, as part of your financial modeling, you can then start to help them understand what the unit economics should be or could be in a D2C versus a B2B environment. And then you can help them, I guess, if they're intent on going down the D2C channel, at the very least, you can hopefully help them structure their pricing model and their discounting and promotions model and everything else such that they at least are taking into account all of the variable costs that they're going to incur. And in many cases, they're brand new variable costs that they've never had to deal with before in a D2C model. Hopefully you can at least, help them build their D2C business on bedrock instead of on quicksand. So is that oftentimes where you have to go in and you have to help them set up their D2C channels in such a way that, it has the net benefit to the business that they expect it to?
Yeah, you know what? I wish that we would be brought into conversations like early in the piece. So, for example, if we're using a hypothetical brand that it begins at B2B and they want to set up a D2C operation, most of the time they'll just do it. But you're dealing with like entrepreneurial founders. They're kind of the go-getters. It's like, hey, we'll just, whatever challenges will face us, we'll just break through the brick walls and just keep hustling. And it's that mentality where there's probably not enough planning for strategically, yes, the product, the marketing, the positioning, that's all kind of well thought out. But when it comes to actually quantifying the cost of that strategy is sometimes not done at all, or not done in a way that's robust and repeatable, and even being accountable to that plan as well. So, again, as I said, we build a lot of budgets and financial models to help quantify strategy. Basically, that's a big part of what we do. And until you build out a financial model to truly understand the unit economics or the variable costs associated with the strategy, and how your business might look like to facilitate that growth, you're really flying blind, honestly. And there's a huge, you're making a big bet. And if you haven't done the work to actually understand how much it's going to cost you, I think it's just silly. But we see it all the time where we're brought in the 11th hour, or brought in too late sometimes, where we're brought in and we see these channels which they're not working, or they're hemorrhaging cash, and the founders are just scratching. They don't even know what the issue is. Like, they're just like, why are we losing money? And it's as simple as that. They just haven't spent the time to really dissect their unit economics through their channels. And typically that's when we're engaged to help them. I wish that sometimes we were involved way earlier in the piece, so we can help them in the strategic stage before they actually roll anything out, because I think a lot of money could be saved, or at least it may not change the outcome, but at least they'll know what facilities or debt, or whether they need to raise money, or they need more bank financing to be able to support or fund that project.
So rather come in as a strategic partner instead of an ambulance at the bottom of the cliff would be an ideally better way for businesses to go with you, or with anybody that provides, I guess, similar services to you. I guess even in the consulting space, we oftentimes get brought in as sort of an ambulance at the bottom of the cliff. Oh, we've tried to do this and it's gone up in flames and we don't really understand why. Can you come in and help? And it's sort of like, wow, okay, there's now you're dealing with sometimes board pressure now, you're dealing with CXO pressure now, you're dealing with you're dealing with a whole new set of dynamics and politics within a business when something has either failed or is not going as well as perhaps was forecasted or projected, and you're trying to sort of clean up the mess on the fly. It's like trying to change the wheels on your car while you're going down the motorway at 100 kilometers an hour, right? And I'm sure you get that a lot. Are you also seeing, in addition to that sort of rush in, put out the fire, help try to restructure a business in a more sustainable way, are you also seeing a much greater demand from B2B businesses who are either going and trying to set up an e-commerce function for the first time, or have neglected their e-commerce function for a decade and it's sort of crusty and old, and they don't do much business through their e-commerce channel today, and their customers are saying, hey, we expect to be able to transact with you in a B2B fashion through e-commerce. I don't want to have to deal with a field sales rep or an account manager or a BDM every single time I want to make a purchase. I just want to be able to jump online and purchase, because, those B2B customers outside of their day job are also B2C e-commerce customers in the evening, their weekends, et cetera, and even increasingly from work. So are you, that's what I'm seeing. I'm seeing because of COVID and because of so many traditional B2B sales management models not being able to be executed during COVID with lockdowns, B2B businesses are getting much more demand for e-commerce functionality and e-commerce enablement, or let's just say digital enablement, even if it's digital enablement of field sales reps, BDMs, and AMs. There's definitely a renewed interest in a massive way for B2B businesses to bring e-commerce enablement to their operations. Is that a change that you're seeing as well? And what other impacts of COVID have you seen?
Yeah, we know from macro perspective, we know what's happening. I haven't seen it directly with clients who have always been B2B but pivoting to B2C. I guess empirically, we know that is shifting into the market. In terms of the broader question around changes in COVID, I think that what we've seen, probably more the impacts of COVID, but also the post effects of COVID. I think that last year was an anomaly for anyone in D2C or even retail generally. It was a one-off. It was a kind of a blip, and we saw these. Everyone made tons of money. Everyone made lots of sales. Well, they should have anyway. If most people did, if you didn't, question marks around the business. But if you're in D2C e-commerce, you would have made a lot. You would have seen a big uptick in order volumes, conversion rates, sales, and a lot of people made a bunch of profit last year. But what we've noticed is kind of since January, the peak was December and Christmas, and then it just really has been flat for the last 6 months, January all the way through to May and now June. It's been quite flat actually, and I think that's what we're seeing in the market is we saw the effects of the job keepers or the government's kind of giving stimulus money to people to retail to ordinary folks. So they've spent that money, and then we saw the impact of lower interest rates, and so that everyone's maxed out their credit cards, and so that happened in that peak period, and now people are just kind of readjusting to the new normal. And we're just seeing the direct impact to sales really, and it has been slow, and couple that with supply chain issues. So everyone was everyone was screaming for supply, lots of issues with the Suez Canal and high shipping rates or whatever. So a lot of retailers were overstocking. They're like, well, I don't want that to happen again. Let's buy more stock to be conservative. And so what's happening, we're seeing is a massive cash crunch. So you've got retailers with like heaps of stock because they wanted to avoid a supply chain issue like last year. But now they've also seen flattening sales. And now they're having to pay tax. Now a lot of people's tax returns are due for all the profit that they generated last year. And so there's this massive cash crunch we're seeing right this moment, with excess stock, lower sales, and tax compliance bills due all in the same period. And it's actually quite a interesting scenario because there's a compounding effect of a cash crunch. And so we're working with a lot of brands at the moment to work through what's the aftermath of COVID rather than what has been a change. It's like, okay, cool, that was a really nice bump. How do we adjust to this new normal, and how do we kind of how do we recover from the hangover effect per se?
Totally, yeah. And the other thing we're seeing, I think there's two lingering effects that I'm witnessing in the marketplace is that, businesses that perhaps were omni-channel and maybe they had a small store estate or maybe even a big store estate combined with digital channels and maybe click and collect, et cetera. And then literally overnight with lockdowns, where perhaps e-commerce was maybe 10, 15, maybe a max of 20% of their overall business, they literally in the span of a week went where that shifted to where it was 100% of their business, or it was 95% of their business, or it was 90% of their business. And then as rolling lockdowns continued, it stayed elevated at maybe 70 to 80% of their business. And they realized overnight, shit, we are not prepared to have 100% of our revenue come through e-commerce channels. We're not structured for it logistically. We're not structured for it in terms of people and HR and even just technical capabilities and pretty much everything associated with 100% of revenue coming through digital channels. We are not designed to do that as a business, because we've architected our business to plan on a 1% increase in e-commerce as a total sum of our business. We've planned that to increase at about 1% a year, which is the national average in New Zealand and Australia, e-commerce as a total percentage of retail. So obviously COVID brought that forward probably by about 10 years, so about 10%. And that's possibly going to be where the new normal lands, somewhere between 5 and 10% increase in total e-commerce penetration of total retail, is where the final numbers will land as a structural change to the market. And even that has some massive downstream effects in terms of supply chain, in terms of distribution being orientated towards individual parcel items being shipped to customers instead of just replenishment of stores, and just reorientating everything to do with people, processes, and systems has been a massive change for businesses. And what I'm seeing in line with what you just said is, now they've kind of unwind some of that. So they reallocated huge resources to their e-commerce channels, and now they're having to go, okay, some of this is unwinding as lockdowns are slowly coming to an end, and how do we reallocate resources in terms of channel mix, and how do we support those channels in wherever they land? And so it's creating a lot of angst and additional cost in businesses as they restructure teams, they restructure locations, they restructure warehousing, logistics, 3PL, 4PL, global logistics, etc. So it's an absolute minefield, I guess, of cost and restructuring for businesses. So there's a lot to it.
Absolutely. And the other thing we forgot to mention was competition.
Of course.
It's inherently a low barriers to entry kind of play. It's like, Shopify makes it so easy to set up a business overnight. You can have a store operational in less than 2 hours. You can buy all the stuff from Alibaba, and you've got a business. And I think you got more merchants have entered the market. Yes, the market size has grown because of e-commerce penetration, but you've got a lot more players in the market, particularly driven by those B2B businesses who are now pivoting or shifting into B2C. So rising CAC because of more people acquiring ads, more competition, deterioration of the same supply chain issues. And so, you can see that it's tricky. It's really tricky.
Yes, in many respects, it's really a really good time to be a merchant, and in other respects, it's a really, really challenging time to be a merchant. But I think that old saying is true. Are you a peacetime general, or are you a wartime general? And I think what we're going to see is a consolidation and a shakeout over the next 12 to 18 months of the really strong brands that did it well and handled COVID well, and created a scenario whereby their customer experience didn't suffer despite the explosion of their e-commerce demand. The brands that were able to either stand up a new e-commerce functionality in their business for the first time and do it really, really well, there's going to be a real strong bifurcation between winners and losers as I see it. So yes, there was a lot of new brands that came online, or a lot of brands that either established or grew their e-commerce channel substantially, but not all of those did it well. And what that means is they acquired a whole lot of new customers, but if that first experience that they had with that business was really crappy, because either they were out of stock and the customer didn't know it until after the fact they placed their order, and then they had to have a refund, or there's any one of a permutation, or shipment took much longer than expected. So instead of the customer expecting it to arrive overnight, it arrives a week later. There was it was a mixed bag of experiences during COVID for a lot of end consumers. And so some brands did more harm than good to themselves because they just simply weren't able to create a good e-commerce experience. And so, once bitten, twice shy, those consumers are going to be really, really hard to reacquire again. So I see a massive shakeout coming to the industry over the next 12 to 18 months of the brands that did it well versus the brands that did it but not so well. Do you think that that's a likelihood as well?
Yeah, for sure. I mean, I think that's applicable for all businesses, though. It's like, irrespective of what you sell or where you are in the market, it's as long as you deliver, you have to. The best brands with the best customer service, the best repeat customers will always win, irrespective of what you do. So I think, 100% right. But yeah, it's applicable to everyone, including us. Your business, my business, it's all the same.
It is, right. And look, and I think we've talked about this before, that both of us, we have to limit to a degree, because we are a customer service based business, and we are effectively selling time for money. You can slice and dice it a million ways, but ultimately you're selling time for money. And so when you're in a client service business like we are, there are limits to what we can do in terms of scaling. And so sometimes we're in a position, an unenviable position, of having to either turn clients away or try to onboard new staff in a hurry to meet the market. And it's whether you're selling widgets or whether you're selling time, there's no easy answer to all of this, is there? You've got to adapt on the fly.
Yeah, unless you sell software, and that makes it easier. But
yeah, unit economics of SaaS software is pretty damn good.
Yeah, exactly.
Awesome. Well, look, Jace, I really appreciate your time. We're coming to the end of our time. It's pretty much been an hour already, which is amazing. I've really, really enjoyed your insights. I love what you do in the market around education. You put a lot of free education into the market that I think merchants, if they don't follow you on LinkedIn, if they don't follow you on your social channels, they absolutely should, because you're pumping out some serious value in your free content and your free advisory. And I realize obviously that's a little bit of a tease for hopefully businesses coming and doing business directly with you and getting the real deal, the real secret sauce directly from you. But I think that even just the free content you're putting out is so valuable for merchants. I hope people follow you, and I wish you every success, because I think you're really targeting a segment of the market that's been underserved for a really long period of time, and you're targeting it in such a way that you are democratizing the understanding of the financial underpinnings of these businesses, and I just think that's such an important role that you have in the marketplace, and I know you don't take it lightly, but it's financial acumen and financial nous within businesses is just absolutely mission critical if you're going to be sustainable, right?
Oh, absolutely. And thank you for your kind words. I mean, we're just trying to teach you the stuff that you should have learned at university or at the high school, really.
Yeah, well, I guess you're filling a gap that just a lot of people just never, again, as you pointed out, a lot of people think they're entrepreneurs and they go into it and they go into it full of enthusiasm and gusto and maybe a bit of family money or something like that, or a bit of investor funds. And they're problem solvers. That's ultimately what entrepreneurs usually are. But oftentimes entrepreneurs maybe don't have the grasp of their numbers that they should do. And that's where you and people like you come in. So, keep fighting the good fight, man, because I see it as a really important function you play in the marketplace. So thank you for your insights. Love to get you back on, in maybe 6 or 12 months and see, as the COVID hangover wears off, how you're seeing businesses evolve and how you're seeing maybe the baseline of financial acumen and understanding evolve over time as well with your clients.
Thank you, Jason. It's been really fun. It's been a pleasure.
Yeah. Cheers, mate. Talk to you soon.
You too. Bye.
Thanks for listening to the At the Coalface podcast. If you want more At the Coalface, you can subscribe to our premium e-commerce and digital newsletter, At the Coalface Digest.